The real debate is whether we're going into recession or not. Historically, during periods where there is not a recession, stocks almost always go up. Historically, during periods where there is a recession, stocks tend to drop. Remember, the key driver for stocks is profit growth, and obviously that's much more difficult in a period where the economy is shrinking. Hello, everybody. I am Tom Graff, Chief Investment Officer at Facet, here to break down markets, the economy, and everything that impacts them. So today, let's talk about that jobs report. This was probably the most anticipated employment report in more than a year, I would say. And it came out fairly close to what economists expected. We were expecting about 165,000 jobs added in the month of August, came out at 142,000 jobs. That is an improvement over last month where we added 89,000. Part of the problem is that there was a pretty big downward revision. Last month we thought that was 114,000 jobs. It's been revised down to 89,000. And there's some evidence that these revisions are what's called pro-cyclical, which means that as the economy is weakening, you tend to get negative revisions. That's not universal, but there's some tendency there. Moreover, the unemployment rate stayed steady at 4.2%, but it's still true that that's about 0.7% higher than the low. And we've never had a situation where the unemployment rate rose by 0.7% or higher without there being a recession. There is reason to worry here. Let's talk about whether we're really in a recession or not. 142,000 jobs added is perfectly fine. Historically, it's been true that job gains in that range are very consistent with an expanding economy. And so if we kind of level out here, if last month's really poor 89,000 gain was a one-off, then I don't think there was a recession here at all. Part of what makes this so weird is we're really in a very unusual labor market. The hiring rate currently is about 3.5% according to the job openings and labor turnover survey, and the layoff rate's about 1.1%. Both of those are historically very low. All right, so we have an economy where not a lot of people getting hired, not a lot of people getting fired. Normally, one's high and the other's low, or vice versa. I think that leaves the labor market a bit on edge, and this is why we're a little worried. It could be just a little bit dip in the hiring rate or a little increase in the layoff rate, and all of a sudden we might have negative job growth. As for the Fed, I think this makes a 50 basis point cut, their September meeting on September 18th, a good bit more likely. So that's a 0.5 percentage point worth of a cut. So right now markets are about 50-50 odds priced into futures of either 50 basis points or 25 basis points. I think either could be justified based on the data that we see. Jackson Hole's speech that Chair Powell gave in August, he said that the Fed neither welcomes nor expects further weakening in labor, and then went on later in the speech to say that the Fed was ready to act if there was further weakness in labor. And I think with that negative job revision, with this job number also coming out kind of on the low side, I think that might tilt the balance toward cutting by that 0.5 percentage point as opposed to the more common 0.25 percentage point. The real debate is whether we're going into recession or not. Historically, during periods where there is not a recession, stocks almost always go up. Historically, during periods where there is a recession, stocks tend to drop. Remember, the key driver for stocks is profit growth, and obviously that's much more difficult in a period where the economy is shrinking. So as markets debate, are we going into recession, are we not, there's probably going to be a lot of churn. Now, if we do enter recession, it could be a really unusual recession as well. So I already said the labor market's sort of unusual. Well, that could lead to a strange slowdown. Over the last 3 years, we've actually had a number of kind of mini recessions that were limited to one segment of the economy. We had a freight recession, we had a recession in home building, we had a recession in parts of tech where there were big layoffs there. We had a recession in parts of finance where there were big layoffs there. Retail had a recession for sure, coming out of a heavy buying period during COVID. And so maybe it's true that all of these industries that have suffered kind of these mini slowdowns have gotten pretty lean and therefore are not really in a position where they need to lay anybody off after a slowdown. In other words, I don't think that payrolls are all that bloated at companies, and typically that's when you get a lot of layoffs. And so I do sort of wonder if this position where there's relatively low hiring, relatively low layoffs is a function of these kind of mini small cycle recessions that we've seen over this whole period. And that could make a big difference as to whether we even hit a recession or we just kind of get a lull and then a return to growth. If you like this content, if you want to hear more of Facet's take on the economy, on markets, hit subscribe below. Would love to see you again.